Oh yeah, so hello again, Liam O'Mara, congressional candidate for the 42nd. I'd like to balance my time here by connecting my background in history and my interest in forward-looking public policy. Because the situation we're entering has many parallels in our past, but also some really distinctive elements. And it's going to take a willingness both to learn the lessons of the past and a will to innovate in order to navigate safely to the other side. Now, when people talk about the Great Depression, they often begin with the market crash. And this is understandable, but also wrongheaded, since the economy was fragile for a long time leading up to it. And it is those underlying structural factors which made that depression particularly bad. There are multiple factors, of course, and Dr. Campbell addressed many in his segment. So I want to focus instead on some of the positive lessons learned from the Depression and how we've really dropped the ball in the last half century, returning in essence to Depression era economic ideals that have been undermining the American economy. Now, to start with, um, industrial economies first grow by building capital goods, i.e. what industry needs to build itself further, like factories, roads, canals, heavy machinery, mills, mines, harbors, ships, trains, all that kind of stuff. And these are all long-term and highly expensive assets which are designed to generate revenue. But as capacity expands and the need for these investments slows, the economy needs something to absorb all that production capacity. And so consumer markets emerge. The United States was the first country fully to transition from a capital goods basis to a consumer goods basis back in the 1920s. And the timing there is not coincidental. For the first time, production was geared to serve consumers, shifting the entire logic of the economy. At an earlier stage, capitalism could accommodate vast wealth in the hands of a few, since capital goods required massive individual investments. Though the Gilded Age itself was fragile and built on horrific exploitation and poverty, but its growth was not so much driven by the spending from below, so its depressions were less dependent upon substantial redistribution in order to recover. Uh, and of course, a larger depression was going to grow more likely anyway, as soon as Harding and Coolidge worked to lower taxes for the rich even more. I mean, tax cuts for the rich always lead to recessions, but somehow after a century of experience with this, Republicans still don't care. Anyway, so along with the rise of early 20th century progressivism, the scientific management ideals, and Taylorism, like the efficiency experts, their stopwatches, the early 20th century economy also gave us Fordism. And many people remember Ford primarily for helping to perfect that assembly line based upon interchangeable parts. That's what comes up mostly in schools, but much less often taught is a key insight that helped to make the whole consumer economy work. Ford argued that it was no good having a manufacturing system designed to spew out standardized low-cost goods if there was no market for them. Consumer production in the 19th century had focused almost entirely on luxury goods for the elite, but that wasn't enough to absorb the capacity of production in an improved factory model, so a whole new class of consumers had to be found. This, of course, leads to all kinds of other fun changes, like the birth of the advertising industry is in this period as well. There's all kinds of cool stuff that happens there. But the key element here for us is that Ford decided to raise wages. He reasoned that if he paid his workers enough that they could afford to buy a car, he'd sell more cars. Lo and behold, the automobile industry took off like a rocket and reshaped the landscape of America. It took a while for other business leaders to catch on to the value of paying higher wages, though. Increased efficiency led to far greater hourly productivity, but most business leaders at the time kept that extra profit for themselves. Between 1919 and 1929, when the Great Depression starts, overall productivity went up 43%. But in that same time period, wages went up about 8%. This meant that more goods were available than ever before and more affordably made, but there were not enough consumers to buy them. Now, it took the Great Depression and the strengthening of labor unions and changes in the tax code and the gold standard that Dr. Campbell mentioned there to force businesses to do what was always in their own interests: pay their workers a living wage. And for a while, we had a stable relationship between government and the private sector with just enough free enterprise to see efficient innovation and just enough regulation to see that wages kept pace with productivity gains and the whole economy grew. I want to experiment a little and show some graphics here. So the graphic I'm going to pull up here is from the Economic Policy Institute. It's been reprinted in lots of places. You may have seen it before. There's that. And if you see this, you note the sharp divergence between the value of our labor shooting up here and what we are paid for that labor. And you can see about the time it breaks with the rise of like the Chicago School, neoliberalism, the whole trickle down economics that, again, Dr. Campbell was mentioning. Kind of nasty separation here, right? Now, the right-wing economists have countered this kind of argument by saying, well, the price of many goods has fallen due to trade and automation, and they'll point to things like implicit price deflators or the personal consumption expenditures, and that if we look at that, we'll see things have improved. They're not nearly as much as overall productivity gains, and in the PC terms, only by about half as much. But things get even worse when you start to measure based upon consumer price indexing, which is probably one reason why it's not particularly favored by them. And when this is used, they often pull still a smoke and mirrors trick. So take a look at a graphic here from, let's see, move this one forward. There we go. I've never shared graphics on this thing before, so it's kind of weird. So take a look at this. This is from the Heritage Foundation. You can see like the top line is the productivity gains, followed by the IPD and the PC that I just mentioned. As you can see those here. But below that are two lines for the consumer price indexing. And the first does show a gain, although about a third of what you get for productivity. But the way they go about some of this stuff is, well, they do this by measuring your total compensation, which includes the calculated value of all benefits, like healthcare, stock options, all that kind of stuff, without any regard for whether those are a real gain for the worker. Consider healthcare, which comes up a lot in our town halls. If the real cost of providing healthcare for someone is $2,000 per year, but the company pays $15,000 a year due to the bloated insurance industry, this metric still shows a gain of $15,000 in compensation, even though the employee gets no measurable benefit from that wasted money. Let's oops. Take a look at two again here, and you see, like, the actual wage gain compared to CPI is pretty awful. Now, the Brookings Institution has their own kind of slightly more nuanced graph here, but still shows a pretty large gap widening here beginning in the 1970s between productivity and compensation. And the EPI has put out itself an updated graph which addresses some of Heritage's complaints that it focused only on production workers and blah, blah, blah. And it still shows that wages are indeed way, way below productivity gains here, which you can see here. This is what people mean when they talk about inequality growing in our economy. Now, the arrival of Fordism heralded a transformation of America into a predominantly middle-class nation. And the decline of Fordism since the 1970s has caused that middle class to shrink by 20%, led to major spikes in poverty. More goods than ever before fill our shelves, but we lack the means to purchase them. This in turn caused an explosion in consumer debt. With wages not keeping pace with the cost of living, American families have fallen farther and farther into debt. So, take a look at this graph here, showing showing a sharp divergence between income growth and credit card debt. That's pretty wide right there. This is, again, starting around the time of the Reagan Revolution. You can see where this is dated from 1980 and going up to about the time of the 2008 recession. And then, let's see. This in a little bit more. Take a look at this graph here showing the non-housing consumer debt since about the time of the 2008 recession. Now, if the economy was strong and recovering from the 2008 crash, as the media just keeps saying to us, why is it that the consumer debt just continued to rise? And the simple answer is the real economy never recovered. In fact, the bottom 50% of American households have lost $1 trillion in wealth. The only thing that recovered after 2008 is the markets, so the investors can make record profits while the rest of us get steadily poorer. I promise I'm almost done showing you images here. I know it makes this a little bit goofy here, but I want to make a quick point first about our our tax code and how messy this is. It's sort of ridiculous. So let's. I want to start with. Zoom makes this so weird, doesn't it? I want to start with the situation here under Truman in 1950, and you can see that the lowest paid workers here pay a fairly low overall tax rate, and the highest paid workers pay a significant share of their income in taxes. But this was still enough to produce a lot of millionaires. But if you move forward to, say, Johnson's rates, 1964, you can see a steep rise already in taxes on lower income workers, which was needed to compensate for the loss in revenue caused by giving the top earners a nice cut. But growth continued overall in the real economy because the overall rate wasn't yet awful enough and wages had continued to rise. Things went straight to hell under Reagan's cuts. So here we are in 1985, and you can see how much this has dropped. And you can also see that the lower and middle are getting a real squeeze in order to pay for that cut to the top. This is also, incidentally, what caused the explosion in our massive national debt. I mean, before Reagan, the debt was basically negligible. But there are hidden consequences to cutting the top rate so much that completely undercut all of those supply side economics. Far from helping the real economy by creating good jobs and investment, real investment plunged while speculation exploded. In the 1960s, speculation made up about 10% of stock market transactions, but by the 2000s, it was about 90%. And more fundamentally for our quality of life, the tax cuts lowered wages for most of us. They changed the incentive structure for corporate boards. With taxes so low, the executive compensation could rise from 10 times the average worker to 400 times the average worker. And with less cash available and less incentive to give the workers more, the companies began giving as little as they could to everyone else, hence the break and the stagnant wages for 40 years. Just to kind of I don't know, finish the story at least, and then I won't show any more of these things. This is where we were under W's cuts. This is about 2006. You can see again a massive fall in what the wealthy are paying, and this is where we were by 2018 under Trump's cuts. And you can see by this point the wealthy are actually paying a lower overall tax rate than the working class are. Because again, this is accounting for federal, state, and all taxation, what's sort of like keeping the whole thing running. Which is just, I mean, in addition to being kind of unjust, it really affects the overall economy. But you know, I guess lower paid workers don't have as good a lobbyist in Washington. So yay. Now, why did I spend so much time walking you through tax rates and productivity gains and blah, blah, blah? Remember the Fordist principle that I was pointing to? The workers now have far too little income and far too much debt to cushion the economy from a serious setback. And if our spending falls too far, the real economy can crumble pretty fast. Now, since I'm using the term real economy, I mean like the realm in which the money sort of circulates to buy goods and services, and kind of like separating it from the ones and zeros floating around on like screens in the financial sector and Wall Street, whatnot. But on top of all this, we're seeing right now record levels of unemployment. And for historical perspective, the unemployment rate in 1930 was around 9%. And by 1933, at the peak of the Depression there, it had reached 25%. Have you noticed where we are now? We just hit 24%. We are literally at the level of unemployment in the Great Depression, and with a similar long-term disconnect between wages and productivity, and high household debt on top of that. So our ability to keep spending and support American businesses is extremely limited. So what can be done? To kind of like wrap this up for me, I want to start pointing to some things we can do to improve things. And here's where I'd like to suggest we kind of borrow a page from Franklin Roosevelt's own taste for experimentation. We're simply going to have to be willing to try some things and see what has the greatest effect. But for all of them, they need to address the real underlying structural problems in the way we've managed the economy for the past 40 years. In particular, we need more cash in the hands of American workers, not in the hands of billionaires. This is the only way to get the spending level where it needs to be for the economic engine to keep humming. So let's start by restoring the ability of workers at all levels easily to organize and unionize, as so many at places like Amazon and Walmart have tried. And because this will help reverse the decline in wages and make the US economy as a whole much stronger. Next, we could decouple healthcare from employment by passing an improved Medicare for all, because this would improve the freedom of consumers. It would let them choose their own provider and not be stuck in a network. It allowed them to change jobs, lose jobs, start their own business without fear of losing their coverage, as so many millions of Americans have now lost. It would save us a ton of money by removing a wasteful layer of private taxes, and it'd make us healthier to boot. So, nice bonus. Third, we should create a permanent and generous system of paid sick and family leave for all Americans, because this would let people take time off when they're sick, which would reduce the exposure of others to illnesses and would boost productivity overall. Had this been in place before the pandemic, thousands of infected people could have stayed home without losing their jobs. Fourth, let's stop the economy from hemorrhaging jobs. The German unemployment rate has increased by about 0.5% in the same time here because they're using wage subsidies to let people keep their jobs. The collapse in our labor force was a political choice, and it was a dangerously stupid one to make. The cost to rehire and retrain workers is wasted money, and the whole thing is increasing incentives for automation. Early estimates are that up to 42% of the jobs lost here will never be recovered. They're just going to be eliminated. So fifth, let's do something about automation. Complaining about immigration has long been a racist smokescreen for the real job killer, automation. US actually manufactures more than it ever has, but we do it with far fewer workers. So we need to start taxing the robots and use that money to provide a basic income for everyone. A guaranteed minimum income could solve poverty at last. It could allow people to build up savings again. It would raise our living standards and our consumption levels, and it would compensate for the steady job losses we're going to see in the coming decades. An estimated 47% of American jobs are at risk of being automated away in the near future. Only a fool would ignore the consequences of that rapid change. And to those who would say, "What? You can't give people money?" I'll just point out that such programs are never a charity from the perspective of the economy. Social Security allows the elderly and retired to keep spending money, which helps the economy. Welfare benefits to the poor allow them to keep spending money, which helps the economy. You see why I talked about Fordism and the consumer basis for our economy? For a sixth, how about a nice quick one? How about reforming the tax code itself, which is a block of Swiss cheese for the rich to navigate with expensive lawyers and an incomprehensible muddle for everyone else. We shouldn't even have to file taxes. It should just be done as it is in every other advanced country here. We only have to file taxes because lobbyists want us to file taxes. Yay. So I say let's simplify the process and save the American taxpayer some money. But speaking of money, let's see some real investment in America again. Remember all those buildings, colleges, roads, bridges built during the Great Depression? I guarantee that you have used a lot of them, even if you never noticed the little plaques describing when they were built. And what about the space race and the arms race during the Cold War? Anyone enjoying their computer or smartphone and the internet right now needs to thank direct government investment in new technologies. Per capita, our spending on research and development has been shrinking for years. So how about we invest in a bunch of green industries and climate change mitigation technologies? We could innovate our way out of some of the worst effects of the last 2 centuries of industrial hubris and restart the American economy at the same time. Eighth and last, I'd like to propose some banking reforms. We should strengthen that sector with a 21st century version of the Glass-Steagall Act that Dr. Campbell mentioned, and we should lower the cost for poor businesses to start by, say, I don't know, maybe opening up public banks. The latter could, in fact, save the US Postal Service, since we can easily turn post offices into low or no interest lenders and let them offer many of the financial services. This would provide a massive stimulus to America's small businesses and help to save Main Street. What all these things have in common is spending. And at the end of the day, we're going to have to figure out a way past the current financial paradigm, which sees government deficit spending as a threat. There may be something to, I don't know, modern monetary theory that's worth our investigation and experimentation, since the alternative is pretty dire. Decades of overspending on top of idiotic Republican tax cuts have put the government so far into the red on the current understanding we're in trouble. But we need not be at all, since the whole thing is founded on what is, in all likelihood, a series of false assumptions. Economics is not really a science. But that's a topic for which I have obviously no time. I have greatly exceeded the amount of time I wanted to spend. So I will close by pleading with those watching. If we want to save the economy, we need more cash in the hands of the workers. And to get there, we have got to replace a lot of the people in Washington who don't have the first clue how our economy works and keep voting to make it worse. And let's start by firing corrupt Ken Calvert. So I'm Liam O'Meara for Congress. Thanks for your time.